Okay, hi. Today's lesson is on a statement of cash flow. So this is one of the statements, financial statements that we need to know. Just like we've learned the SOPL and the SOFP, we need to know the structure and the format. So likewise, we need to know the structure, the format of SOCF. We call it SOCF, Statement of Cash Flow. So what is this statement all about? It tells you during the accounting period, what are all the cash inflows and cash outflow? Where is all the money coming in? And where is all the money going out? But then a cash book can also tell you that. So how is this different from a cash book? A cash book will tell you every single nature of the cash inflow and cash outflow. For example, cash inflow, if you receive money from sales, on the debit side of the cash book, you will see the description is sales. Or if you receive money from trade receivable, the cash book will record as trade receivable. Or if you've paid expenses, rental, you will know it's rental or salary or whatsoever. But here, we are capturing the cash inflow and outflow from three main activities. Okay, so you need to remember the name of the activities. The three activities are operating activities, investing activities, and financial activities. So what you're looking at is the statement of cash flow, the format. Okay, so we start with profit from operation. Okay, and okay, I'll tell you what is operating activity? What is cash flow for operating activity? It's actually telling you what's the cash profit. So as you've learned in accounting, if your profit for the year is say 50,000, it doesn't mean that your money has increased by 50,000 during the year, because the profit calculated in the SOPL is based on the accrual concept. So it's not just monetary transactions, but we adjusted for accrual, prepayments, and also we threw in some non-cash items, right? So that is the profit for the year, profit or loss for the year. But here, what we want to see is how much of that profit for the year is cash items. So which means we need to remove the non-cash items. We need to remove the accrual and prepayment. And we just want to see what's the cash profit. Okay. All right. So that's why we start with profit from operation. Okay. So profit for operation is profit before deducting interest, right? Before deducting finance costs. So the reason why we start with profit from operation is because we have to show the interest expense out here. Okay, so we start with profit from operation, and then we add or less non-cash items. Okay, if it's a non-cash expense, we have to add. Why? Because when preparing the SOPL, we deducted expenses, non-cash expenses. So now to remove it, we undo the deduction. So we have to add. So likewise, any non-cash income that we have added earlier, we have to deduct. So in this chapter, you will see that some figures are in brackets. So brackets indicate outflow, negative. Cash is going out. Okay. Okay, we're deducting. Inflow is without brackets. Okay, so these are the non-cash items like depreciation, loss on sale of non-current asset, and so on. Okay, then we also have to adjust the increase, decrease in current assets and current liability. Okay. Now, if you notice, I put here increase in brackets, decrease in without brackets. Okay, for some. Okay, for example, inventory. Inventory is an asset. If inventory increases, that means you're buying them, you're purchasing. So when you purchase, you pay for it. So that's why for inventory, in fact, for all assets, if it's increased, that means you're paying for it. So it's an outflow. Hence, increase will be seen in brackets. Okay. When assets decrease, that means you're selling them and you're receiving money. So decrease is an inflow. So anything of asset in nature, such as inventory, trade receivable, other receivable, when they increase, it's an outflow. When they decrease, it's an inflow. Okay, so how to detect this increase, decrease? You'll be given 2 years of statement of financial position. Example, as an example, I'm just showing you as an example, like you see here, you've got this year's SOFP and last year's SOFP. For example, can you see here, inventory? So last year, the inventory balance was 381. This year, it's 362. So during the year, inventory has decreased from 381 to 362. So the difference, 381 minus 362. So 19,000 will be recorded here as positive 19,000, for example. So that's how you detect the increase or decrease. So if 2 years of SOFP is not given, then the question will spell it out for you whether assets inventory has decreased or increased or whatever. Okay. So remember, assets increase is an outflow, decrease is an inflow. So for liability is the other way around. Increase is an inflow, decrease is an outflow. Because when liabilities decrease, that means we are paying them to settle them off. So it's a cash outflow. Okay. When liabilities increase, we are not paying them. So we are retaining the money. So we are saving the money. So it's taken to be like an inflow. Okay. Right. So we deduct the interest paid and we deduct taxation paid. So how to calculate, for example, taxation paid? Showed you example here. Here. So if you're given 2 years of SOFP, you will see taxation appearing under the current liabilities. So you put in your opening balance, put in your ending balance. So this opening balance is last year's SOFP, yeah, coming from last year's SOFP. This ending balance is this year's SOFP. And then the question will tell you the taxation expense for the year. So we put in all these 3 figures and we balance up the figure. The balancing figure would be the taxation paid during the year. Okay. So I'll demonstrate with a question later on. So after summing all this, okay, this total here is the cash in operating activity. So this total figure could be a positive or negative figure. If it's positive figure, then we call it net cash from operating activities. If it's a negative figure, then we call it net cash used in. So what makes a difference is either you're going to write from or used in. If it's positive, you write from. If it's negative, you write used in. Okay. And before deducting interest and tax, you need to label this as cash either from or used in operation. So again, the same rule applies. If this figure is positive, then we call it cash from operation. Negative, cash used in operation. Okay. So this is where we see the net cash flow from operating activities, from running the day-to-day affairs of the business. Okay. The second activity is investing activity. So investing activity is all about cash inflow and outflow from buying and selling non-current assets and any long-term investments. Okay, so if you buy any assets, there's a cash outflow. For example, you can see here, purchase of long-term investment is outflow because when you purchase, you are paying money for it. Okay, when you purchase non-current assets, it's an outflow. But when you sell assets, they are being converted to money. So that's inflow. Okay. Right. Then you sum them up. So again, if this figure is positive or negative, you use the correct terms accordingly. Net cash either from or used in investing activities. Okay, then comes financing activities. So financing activity is all about how the business is being financed. Okay, so anything to do with capital or non-current liability. So for example, if the company paid dividends, we are paying money, so it's a cash outflow. Okay, sometimes the company will pay back, reimburse capital back to the shareholders since they want their money back. That's an outflow. Okay, any settlement of liabilities, like such as loan, debenture, is an outflow. Okay, but when the company issues share capital, if it's issue for money, then it's an inflow. So here you got to be careful. bonus issue of shares does not involve money, right? Because you credit capital and you debit reserves instead of money. So bonus issue of shares is not recorded in the statement of cash flow. You only record public issue or rights issue where money is coming in. And the amount of money that we record here is the total full amount, including the premium, the nominal plus the premium. Okay, then when the company issues debentures, that's an inflow. So you can always fall back to the double entry. If you know the double entry, then you'll know that whether that item needs to be included in the SOCF or not. And you will also know whether that transaction is a cash inflow or a cash outflow. For example, issue of debentures, the double entry is debit cash or bank, and credit debenture or loan. So any transaction where you debit cash or debit bank is where money is coming in. So it's an inflow. Any transactions where you credit cash or credit bank, it means money is going out because you're paying for it. So that's an outflow. So that's a good way how you can tell. Okay, then you sum up the total of financing. Okay, then we need to total up the 3 activities amount. 1, 2, 3. So you sum them up. Again, this figure could be positive or negative. You call it net increase or decrease in cash and cash equivalent. If it's positive figure, then net increase. Negative, decrease. Okay, so to this figure, you need to add your cash and cash equivalent at the beginning of the year. So this you can pick up from last year's SOFP. So when you sum these two up, the amount that you get here, this amount should tally to this year's SOFP. Okay, so now I'll demonstrate a question. So question number 3. This one. So preparing the reconciliation of profit from operations. So you are provided with the following information. So this question number 3 is where you are asked to prepare a reconciliation of profit from operation to the cash from operating activities, which means we are only required to show this activity only from here up to here only, not the investing and financing and anything beyond that. Okay. So as always, we need to start with profit from operation. So our current year is 2014, not 2013. So this is the profit from operating, profit from operation 82310. So profit from operations 82310. Then I need to remove the non-cash item. So this is where if it's a non-cash expense, I will need to add. If it's a non-cash income, I will need to deduct. Okay, going back to the question, depreciation is a non-cash expense. So I'll need to add depreciation for 10420. Depreciation 10420. And then loss on sale of non-current assets is an expense. It's a non-cash expense. So I'll need to add 800. Okay, so I've just completed this section. So now I'm entering this area whereby I will calculate the increase or decrease in current assets and current liabilities. Okay, so this is where I'm given 2 years of figures. So let's look at inventory. Inventory is an asset. So comparing last year and this year, inventory has increased by the difference between 42,100 and 38,300. So I'll put there increase in inventory. So that will be 42,100 minus 38,300. Okay, but since it's an increase in inventory, it's a cash outflow. So I'll put a negative in front and yeah, show it as negative. Remember, increase in assets is outflow. Then I have my trade receivables. Comparing last year to this year, the amount has decreased. So decrease in assets means it's a cash inflow. So that would be 28,180, take away 26,240. Okay. And the next I have my trade payables, which is a liability. So comparing this year and last year, the figure has increased. Increase in trade payables. Okay, so increase in trade payable is a cash inflow. So 19,640 minus 17,110. There you go. So this is my answer. Since this figure is positive, so I call it net cash from operating activities. Okay, so you can try the next example on your own. Okay, while I show you question number 5. Okay, here's question number 5. Preparing a statement of cash flows. So we are given 2 years of SOFP. Current year is 2015. Last year is 2014. So, and then you're given additional information. So as always, we need to start with the profit from operation. So this year's profit from operation is 60,000. So therefore, that's how I get 60,000 here. Okay, then the non-cash item. Okay, there's depreciation. Okay, let's see, where do I get the figure from? Here. The depreciation charge for the year was 12,000. Remember, you need to take this year's expense and not last year's. So 12,000. And then how did I get increase in inventory? Okay, I compare both years SOFP. This year it was 83. Last year it was 81. So inventory has increased by 2,000. Increase in inventory means it's a cash outflow because inventory is an asset. Hence negative 2,000. Next, trade receivable. So the trade receivable has also increased from 96 to 101. So that's an increase of 5,000, hence outflow 5,000. Followed by trade payable. Comparing last year to this year, trade payable has decreased from 92 to 87. So that's a decrease of 5,000. So decrease in trade payable, 5,000. So it's a cash outflow because you are paying for it. Okay. Now, interest paid, 9,000. So interest paid, the question mentioned here, interest paid for the year was 9,000. So we can take that figure. So since it's paid, it's a cash outflow. Okay, then we have taxation paid. Then we have taxation paid. Okay, for taxation paid, you're given last year's opening balance, taxation liability, and this year's closing balance. So as what I've explained just now, this 22,000, this 22,000 would be the opening balance. So for example, if I key in here, 22,000 is the opening balance. 18,000 is the ending balance. Okay. Now, for this question, they did not give you the statement of profit or loss figure. Now, if the statement of profit or loss figure is not given, when the question just gives you the opening and the closing liability, we always assume that the ending liability is this year's tax charge, which means since the balance carried on is 18, therefore the SOPL would be 18 as well. So therefore what we are paying this year was last year's taxation. Hence the taxation paid will be 22. I repeat, sometimes question just gives you the opening and closing balance of the tax liability. They do not give you what's the taxation charge this year. Then we always assume that what we owe at the end of this year is this year's tax expense. So which means last year's tax liability has been paid during the year. So in this example, taxation paid is 22,000. Okay, so summing everything up, since this figure is positive, so we get net cash from operating activity. Okay. Then we have the investing activity. So investing activity is where we analyze the non-current assets. Okay, let's go back to the question. Okay, we have non-current assets here, but they are shown at carrying value, right? So we need to find out, did we buy or sell? Okay, so you need to open your non-current assets account at carrying value, net book value. Put in the opening net book value and the ending. So this is the opening balance. This is the ending balance. Okay, then the question says that there were no sales of non-current asset during the year. Okay, there were no sales. So which means disposal is 0. Okay, but however, you have depreciation, right? Remember, we have calculated depreciation just now to be 12,000. So therefore, we deduct depreciation. So upon balancing the account, this is the figure that we require. So we must have purchased 30,000. So since you're debiting non-current asset, the double entry would be to credit cash or bank. And since you're crediting cash or bank, that's a cash outflow. So you show as negative 30,000. Okay, so since there's no sale of non-current asset, this is the only item under investing activity, and there's no transactions on any long-term investment. Okay, so next we go to financing activities. Okay, proceeds from bank loan. Where did I get this from? Go back to the SOFP. You'll see a bank loan here. From last year to this year, the amount has increased. So bank loan is a liability. So when you increase a liability, that means we need to credit bank loan for how much? 16,000. Therefore, we debit bank. Right? So that's how we get 16,000. Then the issue of shares, 30,000. If you notice here, the share capital has increased from 120 to 145. Okay, so that's an increase of 25,000. Okay, so I've showed it here. So from 120 is the balance brought down. 145 is the balance carried down. So the increase is 25,000. But that's only the nominal. So you need to check the share premium account as well. If you check the share premium account, the amount has increased from 22 to 27. So which means the balance brought down is 22. The balance carried down is 27. So that's an increase of 5,000. So altogether, what we will debit to bank account is this 5,000 plus this 25,000, which is 30,000. So the double entry like this: debit bank 30,000, credit capital and share premium 25 and 5 respectively. So that's how I get 30,000 here. So don't only consider the increase in the nominal, but you need to check the share premium as well. Okay, so next we have equity dividends paid. So how can I know that? Here it's mentioned here, equity dividends paid during the year, 19,000. So you take the amount straight away. So 19,000 is a cash outflow. So summing this up, we'll get 27,000, and then we need to sum up these three figures. 29,000 minus 30,000 plus 27,000 to give us 26,000. Okay, so 26,000 is just the increase in cash and cash equivalent during the year. So to this figure, we need to add the opening balance. So the opening balance, go to your last year's SOFP. If you don't find cash and cash equivalent under current assets, you need to check them under current liability. Here it is, 11,000. So since it's under current liability, which means it's an overdraft, so it's a negative balance. So 26 plus negative 11,000 is 15,000. Okay, then we go and check the SOFP. See, you can see 15,000. So what you calculate here must tally to what you see here. If you can tally, that means you've done it correctly. So that's how it works. That's the basics of statement of cash flow. Okay, showing you another example, question number 6. Here it is. Okay. Okay, we start with profit from operation, 30,000. Coming from here. And then we add or less the non-cash items. So depreciation is a non-cash expense. Here it is. We add. And then profit on disposal. This is a non-cash income, so you got to deduct. Okay, how do I get 3,000? It's coming from here, you see? Non-current assets with a cost of 24,000 and accumulated depreciation of 19,000. So the net book value or the carrying value is 5,000. Just write this down. From here, the carrying value is 24 minus 19, which is 5,000. But we sold it for 8,000. So we made a profit of 3,000. So we deduct 3,000. Okay, and then increase in inventory, 26,000. Here it is. Comparing 102 and 128, that's an increase. So negative 26,000. Increase in trade receivable, negative 14,000. Here it is. Comparing 118 and 132. And then we have decrease in trade payable, negative 7,000. Here it is. Comparing 109 and 102. Okay, then we sum this up. We get minus 38,000. And then interest paid, 9,000. Okay. Yeah, it says here interest paid for the year, during the year. Take this year's payment, not last year, yeah. It's 9,000. And then taxation paid, 18,000. Okay, taxation paid. You're not given the taxation charge for the year. So you're given opening balance and closing balance. So as I mentioned just now, what you're paying this year is the last year's tax. So 18,000. So since this figure is negative, so we call it net used in operating activities. Okay, moving on to the investing activities. Sale of non-current asset. So this means that the proceeds, how much money we received. So that is indicated here just now. We sold the asset for 8,000. So that's the amount that you will debit cash or bank. Okay. And then we need to work out the purchase of non-current assets. 52,000. So how I got 52,000 is the same approach which I took in the previous question. The opening book value 224 coming from here. This is the ending book value 259. And then I put in the net book value of the disposal. Remember, I calculated it to be 5,000. Okay, the carrying value of the disposal. And then we need to put the depreciation, 12,000 coming from here. And we balance up the account, and this is the purchase of non-current asset. Okay, then you total it up. Okay, moving on to financing activities. Okay, proceeds from bank loan. Okay, it's a cash inflow because when you check the bank loan has increased from 20 to 42. So that's an increase of 22,000. Okay, then we have issue of shares, 45,000. Issue of shares, 45,000. Okay, if you look at the share capital account, I mean, I didn't do a share capital account, but the share capital increased from 180 to 210. So that's an increase of 30,000. And the premium increased from 0 to 15. So that's an increase of 15,000. So altogether, it's an increase of 45,000. And that's how I got this figure. Okay, then we have equity dividends paid, 25,000. That's coming from what is told here. Okay. So we sum this up, we get 42,000. So then we total up these three: operating activity plus investing plus financing. So we will get a net, so it should be net decrease because it's negative. Net decrease in cash and cash equivalent. Okay. Then we add the cash and cash equivalent at the start of the year, which is 14,000 coming from last year's SOFP. Okay, it's positive 14,000 because it's appearing under the current asset. If it was under current liability, then I would have put minus bracket. So negative 37 plus 14,000 would be equal to negative 23,000. So then to confirm that this answer is correct, we check this year's SOFP and see whether it appears under current liability because negative. So we go on. See, there's nothing under current asset. Here it is. This is our figure, negative 23. So you know you've done it correctly. Okay, so go to the rest of the question. And that's what cash flow is all about. Okay, so preparing the cash flow is done via two statement of financial positions given. And sometimes they do not give you the statement of financial position, but they will express in terms of words. Okay, so work through the other questions and go to the past year question. There's one more you can try here. Okay, all right. Now, the remaining section here is an example, but nowadays they don't ask you anymore. How to prepare an SOFP from a given cash flow. So if you're given an opening SOFP, which indicates the balance brought down, and if you are given the cash flow for the year, statement of cash flow, we need to analyze the figures and calculate the balance CD. So all the balance CDs will then be used to prepare the ending SOFP. Okay. So this one, I did not officially teach in class because they don't ask you this anymore, but you can look through it as an example. Okay. All right. So for now, you master the SOCF, how to work the SOCF. But this one, the answer is all here. You can check. See, you have to open up a lot of accounts, and what we are looking for is the balance CDs. Okay, that'll be all for this topic.